Hello, pembelajar online whom I love wherever you are. So today, we would like to talk about company financial statements. But before that, please subscribe, like, share, and also comment my YouTube channels. My name is Dadang Prasetyo Jatmiko. I'm a PhD graduate from Cardiff Metropolitan University in the UK, and I'm an expert in financial area. Please stay tuned. We'll right back after this moment. So, ladies and gentlemen, we will begin our discussion about companies' financial statements. Company financial statements is a financial performance that is a financial analysis and carried out to evaluate past performance by conducting various analyses. In order to obtain the financial position of a company that represents the reality of the company and the potential whose performance will continue. The financial condition of a company can be seen in its financial statements. The statements describes the performance over a certain period. For a statement to be meaningful, it needs to be analyzed first. The analysis that is commonly done to assess the performance of a company is to use financial ratios. The indicators is often used to assess the soundtrack of a bank. However, a new performance assessment concept emerged, namely economic value added or EVA. An annual report is a report issued annually by the company to shareholders. These reports contains the basic financial statement and management's options on the company's operation during the past year and the company's prospect in the future. Financial statements are used by a company as information regarding the financial position, company performance, and changes in the financial position of the company. The financial statements that have been made are used by company itself and interested parties, including investors, employees, lenders, customers, and government. The company has types of financial statement, namely, first, balance sheet, second, commitment and contingency reports, third, income statement, fourth, cash flow statement, fifth, notes to financial statement, sixth, consolidated financial statement. In analyzing financial performance according to EVA and financial ratio, the required financial statements are income statement and balance sheets. So we talk about balance sheet. The balance sheet is one of the main financial statements used by accountants and business owners. The other major financial statements are the income statement, cash flow statement, and equity statements. The balance sheet is also known as the statement of financial position. The balance sheet presents the financial position of a company at the end of a certain date. Some describe the balance sheet as a snapshot of the financial position of a company at a point or at the particular moment or case, just ahead of time. For example, the amount reported on the December 31, 2021 balance sheet reflects when all transactions have been recorded up to December 31st. Because the balance sheet informs the reader of the financial position of a company at any given point of time, it allows a person, such as a creditor, to see the various things the company owns as well as its debts to other parties, as the date indicates on the head of the balance sheet. This is valuable information for bankers who want to determine whether a company is eligible for additional credit or loans. Other highlights of the balance sheet includes current investors, potential investors, company management, suppliers, some customers, competitors, government agencies, and unions. The main elements are: first, assets; second, obligation; and third is equity owner or shareholders. We talk about assets. Assets are goods owned by the companies. They are company resources that have been acquired through transactions and have economic value that can be used for future purposes that can be measured and expressed in dollars or current values. Asset also includes prepaid expenses that have not yet expired, such as prepaid advertising, prepaid insurance, prepaid legal fees, and prepaid rent. Example of asset accounts reported of a company balance sheets include cash, petty cash, temporary investment, account receivable, inventory, supply, prepaid insurance, land, land improvement, building, equipment, and right of ownership. Usually, the asset accounts will have a debit balance. A contra asset in an asset account with a credit balance, or the credit balance in an asset account conflicts or counters with the debit balance that normally exists in an asset account. Example of contra asset includes allowance for doubtful accountants, depreciation, accumulated depreciation, accumulated depletion, and etc. Then we talk about classification of assets on the balance sheet. Accountants usually prepare classification balance sheet. Classified means that the balance sheet accounts are presented in a different group, category, or classification. The classification of assets and the order in which they appear on the balance sheet are current assets, investation, fixed assets, intangible assets, and other assets. Effect on the cost, principal, and monetary assumption. The amount reported in the asset accounts and on the balance sheet reflect the actual cost recorded at the time the transaction took place. For example, a company acquired 40 acres of land in 1950 for $20,000. Then in 1990, it paid $400,000 for an adjacent of for the accessed package. The company's land account will show a balance of $420,000, which is $20,000 for the first plan plus $400,000 for the second plan. This account balance, 420,000, will appear on the current balance sheet even though this plot of land is actually valued as a current market value of 3 million. There are two guidelines that require accountants to report $420,000 on the balance sheet rather than the current market value of 3 million. First, the cost principal direct accountants to report company asset at their original historical cost. And second, the monetary unit assumption direct accountants to estimate how much US dollar or currency value will be when it is stable over time. Unaffected by inflation or deflation, currency value does not change over time. As a result, accountants assume that in 1950, 1990, and 2021 dollar all have the same purchasing power. The cost principal and monetary unit assumptions may also mean that some very valuable resources will not be reported on the balance sheet. The company brilliance team of scientists would not be listed as an asset on the company's balance sheet because the company did not buy the team in the transaction or cost principle, and it was impossible for accountant to know how to put dollar value or currency value on a team or monetary unit assumption. The Coca-Cola logo, Nike logo, and trade name for most companies that provide products for customers tends to be their most valuable assets. If the name and logo were developed or created internally, it would make sense not to appear on the company's balance sheet. However, if a company purchases a product name and logo from another company, those costs will appear as an asset on the balance sheet of company that required the asset. Remember, accounting principle and guidelines place some limits on what is reported as an asset on a company's balance sheet. Then we discuss about effect of conservation. Conservatism. While the cost principal and monetary unit assumption generally prevents assets from being reported at a larger amount on the balance sheet than their original cost, the principle of conservatism will result in some assets being reported for less than their original cost. For example, assume that company's inventory cost is $30,000, but now the current cost at the same time in inventory has dropped into $27,000. The conservatism guidelines instruct companies to report the inventory of the balance sheet for 27,000. The 3,000 difference is reported next as a loss on the company's income statement. Then we talk about effect of the matching principle. The matching principle will also cause certain assets to be reported on the balance sheet at an amount less than the original cost. For example, if a company has accounts receivable of 50,000 but anticipated that it will collect only $48,500 for various reasons, including the reason of customer is experiencing financial problem. Then the company will report a credit balance of $1,500. A contra assets account with the term allowance for doubtful accounts. The combination of the account receivable asset with a debit balance of $50,000 and the allowance for doubtful accountants contra asset with a credit balance means the balance sheet will report a net amount of 48,500. The income statement will report an adjustment of $1,500 as a bad debt expense. The matching principle also requires calculating the cost of building and equipment that have been depreciated over the life of the equipment. This also means that over time, the cost of the asset will be transferred from the balance sheet to a depreciation expenses on the income statement. Over time, the amount reported on the balance sheet for this long-term asset will decrease. Then we discuss about income statement. The income statement is one of the main financial statements used by accountants and business owners, or other major financial statements are the balance sheet, cash flow statement, and equity statement. The income statement is sometimes referred to the operating report. Making an income statement is important because the statement shows the value of the company's profit during the specified time interval. The time period covered by the statement is chosen by the company, and so each company may vary. For example, the title might state, for the 3 months of ending on December 31st, 2021, or period of October 1st through December 31, 2021, 4 weeks ending on December 27th, 2021, or period of November 29 to December 27, 2021. Fiscal year ending on June 30, 2021, period of July 2020 to June 30, 2021. Remember that income statement shows revenues, expenses, gains, and losses. It doesn't show cash receipt or money the company received, or cash disbursement, money of companies pay. People pay a lot of attention to company profitability for many reasons. For example, if the company cannot operate as a profit, the total in the income statement shows a net loss. Bankers, lenders, creditors may be hesitant to extend credit to the company. On the other hand, if the company has been operating well with multiple profit, the total of which is listed in the income statement shows net income, because the company has successfully demonstrated its ability to use borrowed and invested funds successfully. The company's ability to operate profitably as such its importance to current creditors and investors, potential creditors and investors, company management, competitors, government agencies, unions, and other parties. The format of the income statement will vary according to the company of the business activity. However, most companies will have the following element in their income statements. First, income and profit. Income for primary activities, then income for secondary activities, then gains. Second, burden and loss. It includes cost of primary activities, cost of secondary activities, and losses. For example, loss of sale of long asset, loss of lawsuit. If the sum of the revenue and gain minus cost and losses is positive, the overall total included in the income statement is labeled as income. If the net amount or grand total is negative, it means there is net losses. So that's all thing that I can summarize and also send to you today, and we will meet again very soon. Assalamualaikum warahmatullahi wabarakatuh.